Much for having us. We're really excited to be here today. I don't know if you're as excited to have the franchise tax board here. That's not always the feeling that we get, but we are really excited to be here. We've been working very heavily with the escrow industry for the past year and a half, trying to increase compliance with real estate withholding, get the forms filled out correctly so that taxpayers have what they need when they go to file their taxes. And one of the things we routinely hear from the escrow companies, and there's a few escrow officers in here, I think, is can you please talk to the realtors? Because it would really help us if the realtors could educate their clients so that when they get to escrow, there's no surprises. So we're really happy to be here, and I know that this came from a contact I made at an escrow conference, so thank you for having us, and I hope that this is educational and something that you can apply when you're speaking with your buyers and sellers. So I'm Melissa Stone, I guess I should say that, and this is Linda Castles. I am the compliance program manager for the non-wage withholding programs at Franchise Tax Board. That means I'm over real estate withholding. And Linda is our program specialist, so she's very, very knowledgeable in everything to do with withholding. So we will try to answer every question you have before we leave today. All right, so getting started, here's what we're going to cover today. So in the beginning, oh, I have it. I forgot I have control. Usually somebody else is driving for me. Okay, so in the beginning, we're just going to give you a brief history of where real estate withholding came from. Then we're going to talk about the withholding basics, what your role is in this process, what the possible exemptions are available for the sellers in real estate withholding. We're going to talk about installment sales. This is something that comes up a lot and causes a lot of confusion. And we have to talk about penalties. And then we're going to tell you how to contact us if you have questions. We are willing to take any questions you have throughout the presentation. Please interrupt, raise a hand, however you want to bring it up. If you have a question about what we're talking about, if you brought a specific scenario with you today that you want to discuss, please save that until the end. We will answer, we'll do a Q&A time, and then we also will stay around afterwards if there's more questions. All right, so here's our little inspiration, just a funny little government quote for you. When the good Lord calls you home, the government ought not come and get your home. All right, so in the beginning, so this is just our brief history of real estate withholding and how we got to where we are today. So in 1991, California passed legislation that required real estate withholding on non-resident sellers. So that's everyone outside of California. They did this to be consistent with FIRPTA, which I believe you're probably familiar with, the federal withholding for non-residents. So at the time, it was just non-California residents. In 2003, the budget was bad and California was looking for ways to make more money, I think. And they enacted this legislation, which required withholding on all sellers of California real estate. At the time, there was a waiver process in place where you could write into the Franchise Tax Board and ask for a waiver if you met certain criteria. And you had to wait until we reviewed that and sent you back a letter. And it wasn't the best process, but there was a way around it. So in 2005, they passed new legislation that eliminated the waiver process. And this came with the self-certification process, which is what we call the 593C form. That's the copy of the form that you have today. And this is the one that buyers and sellers love and hate, I should say sellers, because it's a way for them to get out of real estate withholding, but they also have to meet certain criteria. So we're going to go into all of that in a little bit. All right, so just the basics of real estate withholding. So real estate withholding, I'm going to move around. I have a hard time seeing stuff. So real estate withholding is a prepayment of income or tax on the gain from the sale of California real estate. So just like with your wages, they take out money up front before they give you a paycheck so that when you file your taxes at the end of the year, you have money in an account that offsets what your tax liability is. It's the exact same thing with real estate, it's just not a wage. So just to clarify, it's not an additional tax. So we hear that sometimes. Even there was new legislation that was posed this year by a legislature who was confused that this was an additional tax. So they're not being taxed on the sale. We're just doing a withholding so that if they do have a tax liability based on the income that they receive from the sale of real estate, that they have money to pay that. It is a withholding credit available to the seller when they file their California tax return. So I think I said that in about 3 different ways. So withholding is required on the sale or transfer of California real estate unless an exemption applies. There are 3 scenarios where there's no withholding. This is the first 3 bullets. So if the total sales price is $100,000 or less, there's no withholding. They don't even have to fill out a form to get out of it. There's just no withholding. If the seller is a bank acting as a fiduciary for a trust, there's no withholding. And if the property is being foreclosed. So those are the 3 scenarios where we don't even talk about it. Any other scenario, withholding is required unless the seller meets a full exemption on the certified Form 593C. And that's what we're going to talk about for the most part today. So why do you care? That's probably what you're thinking. I hope not, but. So, oops, what did I do?
Should be our job.
It's not your job, but you have a trusted relationship with this buyer or seller when they go into the real estate transaction. And generally they're looking to you for advice. So when they have questions, when they have concerns, you're likely going to be the first person they talk to. And if they can have that information from you, they're going to feel better equipped when they go to escrow. And I would bet that the escrow people that are here, I can't remember who they were, would tell you that it's a lot better if they get to escrow and they're not surprised. Because when somebody's selling $1 million property and they get to escrow and find out that they're going to have a 3 1/3% withholding, they're not real happy. But if they know that up front, then it's that you're managing their expectations so that they have a true picture of what that's going to look like. It's going to make their escrow go smoother. They're going to understand the process. And so knowledge is power. Knowledge shared is powerful. Buyers and sellers want to learn from you. So we're hoping that you can help to educate them so that they're ready when they get there. So I'm going to turn it over to Linda to talk about the exemptions. This is the 593C form, if you want to pull that out. And the one that's here, you can set the brochure aside. We'll talk about that in just a minute.
Thank you, Melissa. Okay, so the information that you're going to provide to your client is so important. This is the big part of it. This is the best part, actually, because everybody, even I, want to know how we can get out of paying taxes, right? We all look for that. Okay, so even though it's not a tax, Melissa just said it is not a tax. It's a withholding, but still it's money out of our pocket. And if I was a seller, I don't want to lose that money either. And you're not really losing it, but if they don't know that, then they think they're losing that money. But here's the good part of it. 593C is the certificate which they have to sign under penalty of perjury that they are exempt from withholding, okay? So that's what I'm gonna go over. This 593C that must be given to the escrow agent or whoever they're working with in escrow before the close of escrow. So it has to be certified under penalty of perjury. It has to be provided to the escrow office before close of escrow. Biggest thing on here, just like in any form, any tax form, is the taxpayer identification number. Now, if there is no taxpayer identification number, we don't know who they are. And so, just like the feds, we're going to want to know who they are, especially if it's a foreign seller. Foreign sellers, a lot of them do not have taxpayer identification numbers, as you might already know. So get them on the process, get them to start it right away. So by the time they close escrow, they will have a taxpayer identification number. Okay, so that's really important. So one of the big things to remember is taxpayer identification number. Then they got to check at least one box to be exempt. If they don't qualify for any of them, then withholding is going to happen. It's required, so it's going to happen. But if they can check at least one box, then they can be exempt. must be signed and then given before the close of escrow. That's very important for them to know, because if they do not do it before the close of escrow, withholding is going to happen. That's what an escrow person is going to do. So then your clients aren't going to be happy about that either. Okay, so let's go over the different parts on the I-93C. Notice that there's a part 2, and on part 2 boxes, you'll see that there's at least 10 boxes there. No, I'm sorry, 9. There's 9 boxes there. Those 9 boxes will fully exempt them. So if you look at the part 2, it reads, certifications would fully exempt the sale from withholding. Okay, so if they check any one of those top boxes, then they're going to be exempt, and there will be no withholding. That's what they like to hear, like to know. Now, there's also part 3. Now, part 3 are partially exempt. So we're going to go over that. So let's first go over the full exemptions. So number 1 and number 2 is their principal residence. And most of the sellers, when they sell real estate, is maybe or probably their principal residence, also known as personal residence or their home. That's where they live most of the time. And so if they check box 1, because they qualify for IRC, Internal Revenue Code section 121, which is they have to live in it 2 years, at least 2 years, then they would qualify for full exemption. Number 2 is the last use. That came in with one of the bills that Melissa had described when they brought in certification. Last use. So it doesn't matter if they were in it 2 years or not, but if they're living in it currently and they're selling it, it qualifies. Okay? The third, that's where the sale is going to result in 0 gain or a loss. So if they bought it in 2006 when it was the top, and then they sell it now where it's much lower, most likely they're going to incur a loss because they're way, I think you guys call it they're under, right?
Underwater.
Underwater. So, they qualify for number 3. They just need to check the box number 3. Remember, they gotta check a box. Then they gotta certify it. They gotta sign it and send it in, or give it to the escrow company. 4 is the sale is involuntary conversion. That means that was eminent domain. Someone is going to exercise eminent domain and take it from them. Okay, so that's number 3. So.
4.
Oh, I'm sorry, 4. Thank you, Melissa. So that's number 4. So if, most likely it could be a government or some kind of government that is going to take it for a highway or take it for whatever. They would qualify. They just need to check the box. Number 5, that is when the seller is going to put it, and you might not see this very often, but that's when they are going to form a corporation or a partnership. 721 would be the partnership. But let's say they're going to form a corporation and they're going to be the majority stockholder. Then that's the section 351. So that is their basis in the corporation. So that's going to be their stock, what they're going to get in exchange for putting this property into the corporation. They're going to get stock. That's a non-recognition treatment under 351. And then 721 is when it's a partnership. There's no stock involved, but they get a percentage. They're going to be an owner in that partnership. So that's number 5. So let's go to number 6. Thank you. Okay. 6 is different in that the seller is a corporation. When the seller is a corporation, or even if it's disqualified and has a permanent place in California, let's say it's not a California corporation from out of state, but they're qualified to do business in California, then they must check box 6 and sign under penalty of perjury. So that's a little bit different. And then 7 is when the seller is a partnership or qualified to do business in California. So they're a partnership, maybe an outside partnership, and they're qualified to do business in California, then they can check box 7. Okay. 8 is what is a tax exempt under California federal law. So those are your non-charitable, your hospitals, they're all non-exempt, those. And they know when they're not exempt and they'll check that box. And universities, things like that. Number 9 is when it's an insurance company. They file their own tax return with the Department of Insurance. An IRA, they have a separate tax return. Qualified pension plans, there's a lot of qualified pension plans that buy and sell real estate. So if they check that box, number 9, then they're exempt. Okay, no withholding is required. Yes?
Can you elaborate a little bit on the IRA?
An IRA is an individual retirement account. So let's say one of your clients, the seller, is an IRA. So there's some type of plan that has property, like for instance, if you were,
If it's in an IRA.
you have your home in an IRA and you're going to sell it, it's an IRA. That's where the plan owns that house. Okay.
We have a question back.
Oh, yes.
Did you say that this applies to all or just non-residents only?
All, a resident also. Withholding applies to all. The only way you can get out are those 1 through 9 or like Melissa had said earlier, if the property is under 100,000, it's in foreclosure, or if it's a bank that owns it.
Under the involuntary conversion,
Yes.
does it have to be actually in threat of eminent domain? Or what, can you just know that they're getting ready to file eminent domain if they haven't done it yet? Can you voluntarily sell to the body? They actually have to.
They have to be.
So you have to go through that
Process.
What actually?
That's actually 1033. The IRC section 10.
That's the point where you're served then.
It's when you're served.
Linda, can you repeat the question, because I don't think everybody can hear.
Okay, so he asked if it's going to be eminent domain, and you know it is, and someone else, and you can sell it before it goes into eminent domain, can it qualify? No, it cannot. It has to be section 1033 where it is an eminent domain. That's just the same as foreclosure. It has to be in foreclosure. If it's, you know it's going to be in foreclosure, so you're going to short sale, not the same thing.
Notice of default?
Notice of default, it has to
Is
be,
that qualified? Notice of default?
no, the bank has to take it. Okay.
Just a question.
There's a question about it. When you say principal residence, when they mark the last portion for residence, do you mean 2 out of the last 5 years?
No, I do not. Her question is, number 2, when it is the last principal residence, does that mean 2 of the last 5 years? No, it does not. That's box number 1 is the 2 out of the last 5 years. Last principal residence means that they are living in it currently. That means they could have been a rental property before, and then they had to move into it for whatever reason, and now they're living in it. So once they are living in it, it's last principal residence. That was the last one. It's in sale, going in for sale, and it's their principal residence. That's the last use. Okay, so that's 1 through 9, and I need to get back over there because I left the clicker. So we're going to talk about 10, 11, and 12.
There you go, they can check.
Thank you very much. Okay, so these are partial exemptions. Now, they could also be a full exemption, but most of the time it's a partial exemption. 10 is the transaction will qualify as a deferred exchange or like-kind exchange or 1031 exchange that's known by all those names. Okay, and you know when they're having an exchange, usually they're working with an accommodator, some type of a qualified intermediary. And so if it's going to be a 1031, they're exempt. But once there's boot, or it fails, then withholding is required. So that's why it may be a full exemption, but it could be a partial exemption also, because of boot. Then we also have when the transaction is an installment sale. Did I skip one? Okay. So if the transaction is an installment sale, then withholding gets a little bit more complicated because usually the seller does not want to have withholding on payments they're going to get from the buyer, right? So pre-2009, they were able to have withholding all up front. Well, that stopped in 2009. Now they have to withhold when the principal is paid. So in escrow, the down payment might be $50,000 or $100,000. Well, withholding is required on that amount. Now, also remember, if he qualifies, if the seller, your client, qualifies for anything above number 10, so 1 through 9, you want them to check that box first. So if it's their principal residence, that's going to be an installment sale, check box 1 and check box 9 if you want. But checking box 1 is going to make them fully exempt from withholding. Does that make sense? Because that happens a lot. They'll call and they'll say, they're selling the house and it's installment sale. Do I check box installment sale? Well, is it also his principal residence? If it's his principal residence, check box 1. Forget about 9. I mean, you can check it too. You can check what qualifies and what they'll certify to.
12.
I'm sorry, 12. Check box 12. Thank you. Okay, so it makes sense that. Thank you. Thank you, Melissa. So it makes sense that if it is an installment sale, and that's the only thing they can check because they can't check any others, then yes, you have a partial. So what is going to be withheld is the down payment at the close of escrow. And then the buyer is required now to withhold on the principal when they send it to the seller. Okay? It's a little bit complicated. So an installment sale is where one payment is going to be made after the tax year that it was sold. Okay? So if, let's say there's going to be the promissory note says there's going to be 4 payments, but they're going to be paid by the end of the tax year, then it's not an installment sale. It has to be one payment afterwards. So if payments begin 2 years later, then it's an installment sale because it's after the tax year. Okay? We have a brochure, new brochure, this one, that will tell your clients, the buyer or the seller, all about the installment sale. And if you look right over here, we put stats over there, so if you want to give them that information, that would be great. This way, there's no surprises, and that they know that there is withholding, and that it's not just because you want them to do it, or the escrow company wants them to do it. No, it's because that's required. That's a required by the California Revenue and Taxation Code. So, and also, you can download that. That can be downloaded right off our website. If you take some from here and then you run out, it can be downloaded, printed, and give it to them. So this installment brochure is going to talk about the whole overview for both of them, on both the buyer and the seller, about installment sales. Okay. What is required of the buyers during escrow? What is required of the buyers following escrow? That's the part where they still have to withhold. Okay? And then it also is going to give information for the seller. The seller is the one that wants to know. He's the client that wants to know because that's the money that's going to be withheld from him. So they always want to know. How to elect out of withholding. The seller can do that once he files his tax return. He can elect out of the withholding. And then we also have all our information on there regarding how to contact us on the internet and so forth. So all that information is on there. So if they have questions, have them call us. We'll be glad to answer their questions. I'm gonna give it back to Melissa. Oh, penalties.
I was one slide ahead of where I was supposed to be. But we have about 5 minutes left, so I'm gonna rush through the end of this here. So we're talking about the 593C, and there's a lot of ways to get out of withholding. But what's really important is that they're certifying this under penalty of perjury. So as their trusted advisor and friend through this process, remind them that they should not certify to anything that's not true, because there are some pretty hefty penalties if that's the case. So for the seller, if they do give us a false certification, so they say this was my principal residence and it's really not, and we find out, there's $1,000 or 20% of the required withholding amount, whichever is greater. For the buyer, the responsibility to withhold is on the buyer, although escrow commonly does it on the buyer's behalf. If the withholding doesn't happen, there is a penalty as well. So that occurs when we get these phone calls sometimes from escrow where they say, I'm gonna lose this escrow because I'm telling them that withholding is required. They don't wanna do it, so they're gonna take their business down the street to this other escrow officer who's not following the rules. I wouldn't recommend that because you're putting your buyer at risk. The escrow person's not on hold for that. Or on the line for that. It's the buyer whose responsibility it is. So be real careful that you're working with an escrow person who's staying in touch with what they're supposed to be doing. I know there's a few faces I recognize here that come to the conferences, are really in tune with what's going on. It's really important that they know what they're doing, so they're giving your buyer and seller correct advice. So just real quick, how to contact us. This is on every form we have. This is on every publication. We have a public contact center that all they do is answer withholding questions. So if you're unsure, you think maybe escrow is not giving you the right answer, or your buyer has a question that escrow can't answer because escrow is not allowed to give legal advice to your buyer and seller on how to fill out the withholding forms, call us. We can help you. That's our job. That's what we're there for. Call us, email us. All the information's here. If you do choose the email, please do not send personal information. Don't say I have this taxpayer with this social security number. This is an unsecure email. So we warn you not to do that. Give us a phone call or send us a fax and we can process that for you. But the biggest thing is we want to get across, we're here to help you. We've been working to devise some tools to make this process easier. The installment sales brochure was just the first one. So that's just to help the buyer and seller in plain language understand what's going to happen through this process. We have another brochure that's coming out probably next month that's on trusts. So that's another thing, when the buyer and seller have their property in a trust, there's a lot of confusion on how to complete the withholding forms and what they need to do after, so there'll be a brochure out on that as well. And these are all of our forms, publications, these brochures, you can print them off our website, so it's a good thing, I would say, to have available to inform your sellers and buyers.